Roth conversions, great idea, great strategy, but misapplied can actually wreak a lot of havoc in your financial life. I've got 3 times where Roth conversions are ill-timed and shouldn't be done. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Your financial life, the seemingly disconnected parts are actually connected. And when you don't realize that, and when you're not considering all 6 areas, it can create a mess. That's why I'm going to urge you every single video to work with a certified financial planner, one that's doing comprehensive financial planning, because their job is to look at all 6 areas of your financial life and then help you make decisions to bring synergy to those. Here's an example. Roth conversion, I'm assuming you've heard about it. It's where you transition, you move pre-tax money, say that was already in the pre-tax side of your 401k, maybe already in an IRA, and you transition it over to the Roth side or to a Roth IRA. And sounds like a great idea, right? Let's move money that I've never paid tax on, and in the future, I'm gonna have to pay tax on it. So all the future growth, it's all gonna be taxable. Move that over so that it's growing tax-free and I won't have to pay tax on that growth in the future. Fantastic, I'll take that deal. Absolutely. Oh yeah, don't forget that Roth conversion, you got to pay tax on it today. Okay, yeah, no big deal. I'll do that. I'll make that trade. Well, if you're not doing that in the context of tax planning and comprehensive financial planning, it might have some consequences that could actually mean it creates a big mess. It could be disastrous in your financial life. We see this all the time where people have come in and ready to start a relationship with the CFP, and they have like a bad taste in their mouth about a Roth conversion because they've done it in the past, and it's ended up biting them. So what are those instances where doing a Roth conversion is ill-timed and really shouldn't be done, creates more havoc than it does benefits? Well, the first is the logical one, and that is where you inadvertently, that's the key, push yourself into a higher tax bracket than what you intended. Why is this problematic? Because a few years ago, they got rid of something called the recharacterization. Now, this is a lot of big words that we're talking about here, so jargon-free zone. A Roth conversion, I explained, that's transitioning pre-tax money over to the Roth side so it grows tax-free. The amount that you convert is taxable. Well, there used to be this rule up until just a few years ago that when you do that Roth conversion, it needs to be done by 12/31. If you're then doing your taxes in the spring and you realize, oh, I didn't realize that was going to push me into the next tax bracket. I didn't realize that, I did too much. Let me undo some of it. You might not think, if you haven't done a Roth conversion, in the past, and maybe you just did one recently, you might not have even known that was a rule. That was a rule. You were able to say, oh, I did a little bit too much. Let me send a little bit of it back, or let me undo the whole thing, and you could undo it. That was a recharacterization. Don't let you do that anymore, and therefore you've still got to do this Roth conversion by 12/31, and there's no takebacks. There's no mulligans. And so if you did a Roth conversion early in the year, and then later in the year you got a surprise bonus, you sold an asset that you weren't planning on, you switched jobs and got some higher income, or something else changed, all of a sudden you can inadvertently cause too much income to land on your tax return above and beyond what you were expecting, and sort of end up kicking yourself saying, oh, I shouldn't have done that Roth conversion. Here's a really small example that I think is going to influence a lot of people, or could catch some people. This is, it's the beginning of tax season here for everyone, but certainly at KFG, and we've been preparing clients for this, but we're starting to get some interest tax forms in. And yeah, last year, 2023, interest rates for money in a money market, money at the bank, money in a CD, basically were at around 5% levels all year. So if you've had a considerable amount of money sitting in the bank, maybe you were nervous about investing, maybe you were looking at using a fixed investment as a bond alternative, and you use treasuries or use CDs, something like that, then you were getting a high interest rate, a higher than normal interest rate for the entire year. And if you've got a lot of money, sitting there or earning that amount, you could have a significant significantly more, a higher number as interest income this year. And if you weren't planning for that and you also did a Roth conversion, that could mean your Roth conversion now pushes you into a higher tax bracket. So that's the main primary kind of one of the examples where doing a Roth conversion ill-timed, it could end up costing you. A second time is when it creates an IRMA predicament. And so what does that mean? IRMA, income related monthly adjustment amount. Okay, now what does that mean? What you pay for your Medicare Part B and Part D, by the way, is based on your modified adjusted gross income from 2 years ago. A whole bunch of that doesn't make sense. So it's based on your income before your standard or itemized deduction and before tax credits and all that sort of stuff. Okay, so it's based on your income, but not from last year. It's from the prior year. And if that really frustrates you, it's because by the time this year starts, so by the time 2025 started, your most recent tax return that you filed was 2023. You think logically, well, okay, I didn't realize Medicare, what I pay for my Medicare premium is tied to my income. Okay, you say it is, then yeah, it's tied to my income from last year. No, it's not. From 2 years ago, which means sometimes this can catch you by surprise. And if you're doing a Roth conversion, say at 63 or 64, you may not even be on Medicare yet, and all of a sudden do a Roth conversion, and then 2 years later, get a nasty-gram, a letter in the mail from the IRS saying, or not the IRS, but from Social Security Administration, Medicare, saying, hey, listen, here's the normal Medicare rate, but you're going to have to pay a little bit extra because your income from 2 years ago, 2023, for the 2025 tax year, your income was too much. So doing a Roth conversion and not being aware that it could cause you to pay this IRMA, this Medicare surcharge, can create a big disaster, big predicament, and an unfortunate consequence. And then a third ill-timed Roth conversion example, or where a Roth conversion, great idea, but it was misapplied, and we just had a new client come in and unfortunately share this situation. He didn't even realize he made a mistake, and that's very, very understandable. I've talked about it plenty of times in videos here on the Wise Money Show, but where the individual has heard a lot about doing a backdoor Roth. And they know I'm already funding, in this instance, already funding my 401k, single K, self-employed. So I'm already funding that. I want to contribute to a Roth IRA, but my income is too high. I'm above the normal contribution limits. I've heard that you can do this Roth, this backdoor Roth. So I will contribute to a separate IRA. I'll open up a different IRA. I will contribute to that, and I won't deduct it. And then I will convert that money into my Roth. And here's the issue. So that's a Roth conversion. They call it a backdoor Roth. It's a Roth conversion. Here's the problem. He had, or this individual in this instance, had another IRA with a bunch of pre-tax money in it. And this is, again, this is sort of three examples of Roth conversions gone wrong. Didn't realize that even if you create a separate IRA and you just contribute after-tax money into that, when you go to then do a conversion, they look at your aggregate balances of all of your IRAs and do a ratio to say, well, of all of your IRAs, including simple IRAs, how much is pre-tax and how much is after-tax? And then when you do a conversion, it's that same ratio that is applied to how much is going to be taxable in that Roth conversion. And in this instance, yeah, I had a $500,000 or so pre-tax IRA, and so doing a conversion of $8,000, almost all of it was taxable. Not the end of the world, but not the desired intent, and therefore had some consequences to it, caused some tax because it was a Roth conversion misapplied. So those are three ill-timed Roth conversion examples. In a vacuum, Roth conversion makes a ton of sense, but you've got to look at all 6 areas of your financial life to see if it's a good idea that is worth applying in your situation at this time. And that's why, yes, you need tax planning. What's tax planning? That's the proactive work of identifying opportunities for you to pay the least amount of tax over your lifetime, if not multiple lifetimes, and then connecting that with all 6 areas of your financial life. Tax planning is one of the 6. So then connecting with your retirement plan, your cash flow plan, and so on, and making sure that it makes sense to do in your situation. So work with your certified financial planner. If it makes sense to do a Roth conversion, and for many people it does, then do so with confidence and not have these consequences in these examples that I shared. So work with your CFP on that. If you don't have a CFP on your team, you can contact one of my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.